What's ahead for 2024, and could M&A be one of the driving forces in that space next year? Joining us here at Post 9, Citi's global head of tech and communications banking, Phil Drury's with us. His outlook for those sectors and M&A. It's great to see you. Thanks for coming.
Thanks very much, Carl.
Are we overriding the idea that next year will give us a rebound, or has 23 been so suppressed that there's nowhere to go but up?
I think it's a little bit of both. We've certainly had such a strong rally in the markets. You can't not be more hopeful for a more active 2024. As you said, Nasdaq's rallied 40%, S&P has rallied 20%. The Nasdaq's trading at 27 times forward earnings. That's a 15% premium on trailing 10-year averages. We're forecasting 4 interest rate cycle reductions next year. And to your point, there's been very little activity. So sellers have been on the sidelines, more than buyers, actually. There's been that inertia. But the market feels more investable today. And so that's why we're more cautiously optimistic when it comes to next year. Now, you mentioned mixed news in M&A. It's true. The recent Adobe Figma decision. We also had Illumina and Grail as well. So you have to take that into context with, we were advisors to Broadcom. Broadcom was approved. Microsoft and Activision was approved. So you do need to look under that and listen to the CMA's view on the digital ecosystem. There were always concerns about horizontal M&A, and now increasing concerns on vertical M&A as well. So it is mixed signals, but the market backdrop feels conducive to more activity.
A lot of people talk about antitrust as being a deterrent, rates being a deterrent, geopolitics being a deterrent. I don't see any of those things necessarily clearing up next year. So what gives you confidence that it will be better? Well,
we do see rates becoming more constructive, and I think
still high.
Still high, but perhaps a level of normalization. I think what we need to happen, you see the VIX right now is trading at 12. 12 implies a standard equity deviation of 75 basis points a day. At the peak, we were 30 to 35. That's 250 basis points to 300 basis points standard deviation. So we're more stable. Now, the geopolitical risk is a real one. And also, we haven't talked about the fact that I think we've got more elections next year than we probably ever had in any single year. So the first half is going to be really important, specifically in North America. We need to get off to a good start, make some good announcements, because uncertainty will creep into the market as we get closer to that election.
That's what people say about rates as well, is that you want to front load it because you're getting closer and closer to a big binary outcome depending on what country you're in. So do you think the year starts out strong and then sort of evens out?
The year should set out pretty strong out of the gates. I mean, let's face it, asset classes, particularly the equity market, is a forward look over the next 12 to 18 months. So we certainly believe we've got the right backdrop to start well in the new year. And that's M&A. It's also IPOs. We've been quiet in terms of M&A, although the second half has picked up quite meaningfully. There have been little to no IPOs. We had a flurry after Labor weekend where we actually led to 3 IPOs that came to market, but very little since. So we think we're going to see more dual tracks. Sellers have more alternatives than they had in the past. We think the financing market is going to be constructive. You'll have bank lending. You'll also have direct lenders as well. So we think there'll be a conducive financing market, and sellers will have options between outright sales, but also dual tracking the IPO market.